A warm welcome to everybody from RavenPack. My name is Hugh. I am the Head of Sales and Business Development at RavenPack. It's my pleasure to introduce today's webinar entitled Constructing Indicators from News and Social Media Sentiment. Just to move on to today's agenda, unfortunately I don't have too much to present today, but we will be going through, Peter, if you can move on to the previous slide. The next slide, sorry. We'll be going through some information from myself on RavenPack itself and a little bit of our history. I will then speedily introduce our main speaker, Peter Hafez, who is our Director of Quantitative Research. Peter's going to discuss the RavenPack dataset and highlight some of his latest research. Specifically, Peter's going to look at how to construct aggregate indicators of sentiment from RavenPack's granular dataset and how those might be employed in trading and investment strategies. We'll then answer any questions you may have and of course summarize. Just a bit of admin, please ask any questions by typing them into the GoToMeeting control panel, which you would see normally on the right-hand side of your screen. Alternatively, you can email us at info@ravenpack.com. Also, please note that if we don't have time to answer all your questions during the webinar, we'll contact you shortly afterwards with an answer. So who or what is RavenPack? RavenPack is the foremost privately owned practitioner of text analytics for financial services firms. We've been around for around 10 years and have been working on this particular product, RavenPack News Analytics, since 2008. Many of the world's top quantitative investors use RavenPack data to enhance the performance of their systematic trading strategies or models. But we also have many clients in the discretionary space, some visual space, and also in places like risk management and surveillance. Moving on to introduce Peter, our main speaker. Peter is a very experienced quantitative researcher who's been working with our RavenPack data, I think, for about six years. He's regarded as one of the preeminent experts in this field, and I think he's up to about 25 to 30 white papers on the practical applications of text analytics in finance. He's also presented at countless conferences, seminars, traveled the world talking about news analytics, won awards, and pretty much helped every one of our clients extract more value from our data. So without further ado, I'll hand it straight over to Peter.
Hello, everybody. As already mentioned, my name is Peter Hafez, and I'm the Director of Quantitative Research at RavenPack. The focus of today's talk is to present our latest work, constructing sentiment indicators from news and social media content. Our focus will be on country-level indicators, but the approach can very easily be extended to company-level sentiment, something which we are doing as part of our current research. Here's what I will cover in today's talk. First, I will provide a short introduction to news analytics, focusing on the key attributes of a news analytics dataset. I'll then introduce the RavenPack event taxonomy, which is a very powerful framework for classifying news and to identify themes or trending topics for a given entity, something we utilize heavily as part of our indicator methodology. I'll then describe some of the challenges that we face as part of working with news analytics data and when constructing indicators capturing either media attention or sentiment. I'll then move on to talk in greater detail about how we go about creating our sentiment indicators. Finally, I'll present the results of a case study considering a set of sentiment indicators at a market level, investing long or short the S&P 500. Before presenting some of the more interesting results, let's take a look at the key attributes of a news analytics dataset. Here's an example of what the raw RavenPack news analytics look like. The data can be consumed in many different ways, either as events per entity, as depicted on this slide, as daily indicators capturing sentiment or media attention, or some sort of visual representation of the data. The first key attribute is entity recognition. Obviously, understanding what entities are involved in a news story is key in order to make sense of any other extracted information. Currently, RavenPack covers more than 170,000 entities, including more than 36,000 companies globally, more than 2,000 organizations, and almost 140,000 places, as well as the major commodities and currencies. Recognizing entities can be especially tricky for certain types of entities that have close relation to more common language. For instance, it seems important to understand if a story is referring to the word total a quite common word in financial language, or the French energy company Total. Building archives for backtesting purposes adds additional complexity into the entity recognition process, as it needs to become point-in-time sensitive. For instance, understanding when Bill Clinton speaks under the capacity of the President of the United States and when he's not can be potentially important. Likewise, we want to know when mentions of Gillette should point to its own entity and when it should be pointing to Procter & Gamble as a brand name. The second attribute is relevance, which doesn't refer to how much the story will move securities prices, but simply how pertinent the entity is in the story. Typically, a score greater than 90 means that the entity plays a prominent role in the story, while a score of 100 indicates that the entity plays a targeted role in an event. For instance, a country experiencing a credit downgrade, or a company being the plaintiff or defendant in a lawsuit. The last two important attributes include event detection and sentiment scoring. While sentiment provides an opinion on direction and potential strength, being able to detect the underlying event provides valuable information when deciding on the decay of a signal. In addition, filtering on particular event types can be useful when constructing sentiment or news volume indicators, as certain news may be more noisy than informative, depending on the application in mind. In total, RavenPack covers more than 2,000 events, including diplomatic recalls, interest rate or earnings guidance, lawsuits, layoffs, etc., all of which map into 51 broader event groups and 5 topics at the top level, including business, economy, politics, society, and environmental news. Novelty being the last attribute refers to whether the news is new or novel over some time horizon. We typically consider a one-day rolling window. That is, if there has been silence on a particular event for more than 24 hours, our novelty scoring resets to 100, indicating that it's the first instance of the event. Based on the 5 key attributes, it's possible not only to derive different event triggers that can be more or less sophisticated in nature, but also to construct a set of indicators capturing the sentiment trend or media attention of a given company, sector, or market, placing more weight on more novel events. Before jumping on to how we create our indicators, let's take a quick look at the RavenPack event taxonomy, which is heavily utilized as part of our final methodology. With the RavenPack event taxonomy, you can work at any level of granularity that you're interested in, even tracking changes in, let's say, corporate or economic sentiment for the US economy, all the way down to the underlying event categories at a per company level. At the very top level, we focus on 6 different topics, including business, economic, political, societal, environmental, and corporate events. The corporate indicator has been created as a spin-off from the original 5 topics in order to isolate corporate news from broader macro news. The set of topics are split into 51 potential groups or themes per economy, including bankruptcy, civil unrest, credit ratings, labor issues, or war and conflict. Then into types, providing additional granularity. And finally, at the very bottom, RavenPack covers more than 2,000 different event categories spanning anything from house price or interest rate guidance to diplomatic recalls, lawsuits, or different kinds of earnings events. Having covered the structure of the underlying news analytics, let's move on to the more fun stuff. Overall, our objective is to present a robust methodology or framework that can be applied as part of constructing a set of media attention or sentiment indicators made up by a set of group level indicators that can be combined depending or in different ways depending on your target instrument, just like legal blocks. Even though our focus in this presentation is to cover country sentiment, the structure of the underlying data allows for the construction of any proprietary indicator, for instance, focusing on company sectors, commodities, currencies, or perhaps even capturing relative sentiment between different styles, including growth and value companies. As we expand our source coverage in terms of news, adding more and more content with different types of characteristics, we're also potentially adding more noise into our framework. These characteristics could include update frequency, for instance, some sources being real-time news wires versus, let's say, a weekly or monthly blog. To alleviate this type of noise, we focus on the concept of news volume abnormality, which looks for spikes of news volume rather than on the news volume of a given country. That is, we look at deviations from news coverage from the historical mean daily volume, i.e. taking some sort of set score approach. Another element to take into consideration is that not all news volume is created equal. Some information is likely going to be more important and hence should receive more weight when aggregating news analytics. In order to address this issue, we utilize the RavenPack event taxonomy to categorize news according to the covered topic, for instance, M&A activity, war, conflict, or unemployment. Taking this approach allows us to identify important themes driving news volume or sentiment for a given entity of interest. But categorization doesn't have to be purely topics-based. For instance, we may be interested in focusing on volume or event themes that relate to a given relationship. Let's consider the example back in 2011 when Google acquired Motorola. Prior to the announcement, there were more or less no news mentioning the two companies in the same story. At the time of the acquisition announcement, Motorola went from 0 to accounting for more than 40% of all stories mentioning Google with some other company. Interestingly, after the announcement, the forward-looking stock price correlation went up, indicating a regime shift in the relationship between the two companies, something which would have been almost impossible to identify tracking price data alone. Not only were we able to identify the regime shift, but also the theme or top events driving the conventions. A similar convention approach can be applied at country level, capturing global macro relationships. For instance, prior to 2014, we saw few conventions between Ukraine and Russia, but as soon as the Crimean crisis broke out, convention volume started to spike massively, not only for Russia, but also for the US. But while the events driving the US-Ukraine relationship were much more passive, including sanction guidance and economic guidance, etc., the events driving the conventions between Ukraine and Russia were much more aggressive, including protests, military actions, civil unrest, diplomatic recall, and airspace violations. Hence, tracking convention relationships can be a good way of identifying changes to the geopolitical landscape. Actually, even before the Crimean crisis, an interesting relationship emerged between Ukraine and the IMF. Back in late 2011, the IMF had a stable credit view on Ukraine. In mid-2012, they organized an official visit to the country, followed by a credit rating downgrade a year later. In early 2014, there were already talks about a government bailout. While news conventioning is a very interesting way of classifying news volume and to identify new relationships, the methodology presented as part of today's presentation focuses purely on event categorization. However, more research will be conducted looking into the development of these kind of convention relationships. Until now, we have focused purely on abnormal news volume and the themes driving it. Unfortunately, media attention says little about price direction. Hence, rather than looking at news volume abnormality, we want to consider the concept of sentiment abnormality, which is basically a hybrid of abnormal news volume and sentiment strength. That is, our sentiment indicator takes more extreme values if driven by more news volume abnormality or by events considered to be more extreme from a sentiment point of view. Finally, with the objective of creating indicators at country level, how do we come up with just one value per country, for instance, capturing the sentiment of the US economy? Well, we don't. Instead, we create a set of indicators capturing different dimensions of sentiment that we might be interested in, including business economy, corporate, political, societal, or environmental sentiment as mentioned previously. The reason is that we don't believe in one size fitting all asset classes. Instead, we believe in creating a framework or a set of sentiment Lego blocks that can be mixed or matched depending on the instrument you decide to trade. For instance, if you want to trade equities, you may want to overweight corporate news, while economic or political news may be more important when trading forex interest rates. Having presented and offered solutions on some of the challenges that we face when creating news-based indicators, let's have a look at our final methodology. As a first step, we create a daily sentiment score at group level, in this case at country level, aggregating the RavenPack event sentiment score after rescaling it to take values between -1 and 1, to weight novel news more heavily, we multiply the RavenPack event novelty score onto our sentiment scores. We then normalize the daily scores using a set score approach, thereby identifying sentiment abnormality within a given event group. This allows us to identify key drivers or themes driving current sentiment. And finally, we create a daily topic level sentiment indicator by weighting group level sentiment according to their relative median absolute sentiment score as observed over the past 365 days, placing more weight on groups that typically receive more extreme sentiment. Here is an example of what the corporate topic sentiment indicator looks like, aggregated over a 91-day horizon for visualization purposes. The blue line is our sentiment indicator, while the red line is the S&P 500 cumulative returns. To explain changes in US corporate sentiment, we have identified some of the key themes. If we look at early 2009, around the low point of the S&P 500, the market seemed to have been driven primarily by a rise in bankruptcies, price target downgrades, lower dividends, and less corporate equity actions. While during the following recovery, more favorable analyst ratings, improvements in earnings, and fewer bankruptcies were observed. If we turn our attention to economic sentiment for the US, sentiment already reached its low in early 2008, driven by lower consumer confidence and economic growth, as well as by an increase in recession expectations. Stronger economic growth guidance and higher unemployment contributed to the following recovery. To evaluate our indicators, we create a predictive model targeting the 1-month forward returns of the S&P 500 index, creating both a set of directional, long-only, and long-short strategies. We include up to 7 input variables covering our 6 topic level indicators as well as past returns of the S&P 500. And we allow up to 6 monthly lags in our model, thereby allowing past returns and sentiment to impact future returns. The number of variables and lags to include in our final model is based on a dynamic regression model using a stepwise AIC procedure and 5 years of data for model estimation. For benchmark purposes, we also consider a simple buy and hold strategy and a pure price-based model on the S&P 500 following the same methodology as the sentiment-based models. That is, we want to understand if we are providing any additional value beyond a simple price-driven model. Given the large number of lags and input variables included relative to the size of the historical data set used for model estimation, to check for robustness, we consider a model only including corporate sentiment, a 3-lag model, as well as a weekly model, which introduces more degrees of freedom in our model estimation. Let's take a look at our monthly strategy performance. In the top panel, we include the performance statistics for the long-only versions of the strategy, while the bottom panel presents the long-short strategy performance. The backtesting period covers January 2008 through August 2014. As can be observed, the sentiment-based models outperform our benchmark models, both when it comes to the long-only and long-short models. The corporate sentiment model has delivered an information ratio of 1.15 and 1.36 for a long-only and a long-short strategy respectively, while the full model, including both sentiment and returns, has yielded information ratios of around 1.45 in both cases. Hence, while corporate sentiment seems to be the key driver, additional value can be found by including other sentiment dimensions into our model. Generally, we find that the macro indicators add most value on the monthly horizon and when including longer lag periods. In contrast, corporate sentiment shows similar performance in a 3-lag model with an information ratio of 1.10 and also seems to hold predictive value on the weekly horizon with information ratios of 0.8 in comparison to less than 0.3 for our return-driven and buy and hold benchmarks. On this slide, we show the cumulative return of our strategies and benchmarks, with the purple line representing the buy and hold benchmarks and the dark blue and green lines representing the long-only and long-short return-based benchmark models. Considering the year-by-year performance of the long-only models, we can observe that the corporate news model outperforms the return-based model in all years but 2007. Compared to buy and hold, it outperforms in all years but 2012 and 13, which were generally considered strong bull markets, creating less opportunities to outperform a buy and hold. If we allow shorting of the index, it can be observed that both of the sentiment-based models have had no negative performance years since 2007, and actually turned a profit in 2008 between 17 and 38%, as compared to a 50% drop in the buy and hold strategy. Again, the only years with underperformance were during the strong bull market period in 12 and 13. It should be noted that we're currently working on rolling out the methodology to company level, where we are finding interesting results across Russell 3000 constituents. However, with sentiment being stronger and decaying more slowly as we move down the size scale. These early results seem to indicate that the suggested methodology is robust across market and company level, as well as across company size. In summary, we have shown that focusing on sentiment abnormality, we're able to construct indicators with better predictive power than simply relying on price data only. That the RavenPack event taxonomy is a valuable input to identifying themes driving country-level sentiment, and that it can be useful for bucketing news volume to help alleviate potential noise. We showed that when trading equities, market returns are primarily driven by corporate sentiment, while macro sentiment adds additional value mostly over longer horizons. Finally, our research shows that the methodology is robust at both country and company level, even though little attention was placed on the latter in this presentation. As part of future research, we plan to utilize our topic and group level sentiment blocks to expand our analysis to other countries as well as into other asset classes, including fixed income and forex. I hope you have enjoyed my presentation. If you're interested in learning more about our research or about our data, please feel free to reach out to us. That's it from me. Now back over to Hugh, who will open up the floor for questions.
Thank you, Peter. I have a couple of questions here that came on the floor. Firstly, you showed a couple of slides, one with the corporate sentiment indicator and then the economic sentiment indicator, and you plotted them against various prices. But over time, it seems that at some stages the correlations fall apart. Why is that, and what could be done by the people on the call to improve the predictability or correlation of the relevant market?
Well, first of all, I think even though the two lines seemed aligned nicely over time in the graph you're referring to, they're actually not directly comparable in that the sentiment indicator is a 91-day moving average and can hence be considered more of a bounded variable, while the S&P 500 is a continuous cumulative value and is therefore unbounded. I guess a better comparison would have been to have plotted sentiment against the 91-day moving returns of the index itself, but this would, however, have been at some loss of intuition of tracking the S&P 500 return profile itself. And in terms of improving the predictability of the relevant market, well, I guess economic sentiment is not the only driver, and neither is corporate sentiment of equities markets. There may be other factors omitted from the graphs or from our model that may help improve the results. Some other non-news related factor.
Okay, I just wanted to pick you up on that. I mean, I know that you've done research in the past that looks at the interaction between non-news factors and news sentiment factors. I wondered if you might spend a little bit of time just talking about some of the historical research you did on how clients have looked for interaction between traditional factors and news sentiment.
Yeah, that we have in the past done research on some of these interaction effects, and if you look at some of the more traditional factors like momentum or value or quality, etc., we have actually found that sentiment is a very nice overlay to kind of distinguish between, if you look at long-term momentum, companies that may be a likely continued momentum stock or stocks that may be running out of momentum. So, for instance, if you start to see more negative news coming through, well, you might not want to take a longer-term momentum position on that particular name. Likewise, on when it comes to value, news is actually a pretty good way of identifying or preventing you from moving into a value trap. Some companies may seem cheaper and expensive, but the reason may simply be because they've started to see a lot of bad press, and that bad press may not have been reflected yet on the balance sheet. And finally, we also see that sentiment distinguishes quite well between, can you say, quality stocks, strong quality stocks that may have positive or negative sentiment to them as well. So that's definitely one way that you can enhance the more traditional factors and still, let's say, keeping full control of the turnover that you have in your model.
Okay, great. Now, one of the performance charts you showed, the long-short performance is pretty close to the long-only performance, and so someone's asking, why is that so close over time, and what percentage of time were you short over that period in this particular model?
I will say, of course, this period is very much characterized by a strong bear market as well as a prolonged strong bull market. There were probably only really two serious downturns. There was, of course, the financial crisis, credit crisis, as well as the 2011 correction we saw as well. I will say that all of the long-short models outperformed the long-only models, but of course, a lot of the extra performance you got out of the long shorts were characterized or were primarily driven by the 2008-9 period, but we were also able to position ourselves correctly through the 11 period. In terms of the percentage of being long and short in the model, we actually didn't look at that specifically, but it's definitely something that we can provide information on if the one can you say and we will follow up on the question in an email afterwards. I think we have the details of the person asking the question.
Okay, great. I have one of the things that is evident is that even though the model you tested contained or uses the macro data set, it seems for corporates in the form of the S&P, it isn't as useful as you might expect. Surely, given the strength of the risk on, risk off that we've seen over the last 4 or 5 years, you would expect macro data to play more of a role in the performance of an S&P strategy.
Yeah, there's no doubt here. What we found was that the corporate news seems to be the key driver, and it also seems to be most robust. But we did find the macro, as indicated, to add value, macro sentiment, the different sentiment dimensions to add value. But you really needed a number of lags to capture the macro trend forming over longer time periods. There could, of course, be certain time periods that contributed mostly to performance from macro sentiment, and we didn't really dissect that into the contribution into sub periods. But that may be an interesting additional analysis to do to see if there is something here in terms of the macro picture. But I guess eventually corporate sentiment will eventually become macro news, right? So it may just be that it's slightly more leading and therefore provides more value there.
Okay, and I believe this particular strategy, we didn't have transaction costs included. Is that correct? And if not, why not?
That in this particular one, yes, that is correct. There's no, can you say, real reason for doing it. I would say it wouldn't really hurt the strategy particularly much. It's something which is relatively inexpensive to implement, either through ETFs or through a futures contract. And the turnover as the strategy is actually not particularly high. So we might as well have put it in there, but in this particular case we didn't. But it would still yield or significantly outperform the benchmark strategies.
Okay, and then a question just came in, so it's quite a technical one, so bear with me. If part of the model is using some of the regression analysis with AIC scores and lag periods, which are usually coming from liked time series models, I suppose this model can be somehow discrete and not continuous. What do you think about that?
Yeah, I guess it could be. I will say that we are applying this as on more of a discrete type framework, in that we are either long or short, even though we actually have a prediction, and that may be weaker or stronger over time. So you could, of course, have the strength of the prediction feed in as well. But as I mentioned, we just look at it from a binary point of view. And the other point is that you could also end up in situations where you had no view on the market. We didn't end up in that situation, but in theory, you could end up in that situation. And in those cases, I would say you would probably just be flat. I hope that answered the question.
Okay, now you mentioned co-referencing in the beginning of your presentation, and I didn't see any practical application of that in the presentation, and I wondered what you see as the practical application of co-referencing in the future.
I think there are multiple ways that co-referencing could be applied. We are still researching the co-reference data and its applications, but there are multiple potential applications under review. For instance, as part of a risk management process, the data may help predict changes to cross-asset correlation or price volatility. We may be able to help with counterparty risk analysis. For instance, we could see how entities are related to riskier ones and observe if already known relationships looks to be growing weaker or stronger, or perhaps even terminating. Also, the spillover effect on price for related entities may be expected to be greater for companies experiencing strong versus weak co-referencing in the media, as the relationship may be considered more relevant at that point in time. And besides different investment applications, I also see news co-referencing being very interesting from a business intelligence point of view. That is, what are my competitors, suppliers, or customers doing? Are they buying companies that could affect our relationship, or are they moving into new business segments or introducing new products? Generally, I'm very excited about the applications of this type of data, and it's something that we're definitely putting a lot of research efforts behind.
Okay, and I know that you did some research with a co-referencing, or at least a entity relationship data set from FactSet. What are the differences between your approach to co-referencing and using FactSet's data?
They are very different in the way that the relationships have been can you say, extracted. I would say the Revere FactSet data set is very interesting in that these are, can you say, known relationships that have been extracted from regulatory filings. So you can say it's kind of self-reported relationships by the companies themselves. The disadvantage with that kind of data is that it's relatively static, because filings are not particularly frequent. But what I think is very interesting is that you could actually combine that with news co-mentioning, in that you could, can you say, overlay it with these relationship scores to identify relationships, even known relationships, according to the FactSet data set, and say, is this relationship growing weaker or stronger? I know that these are suppliers, but has the media perceived the relationships as being strong right now or weak? Or we may even be able to detect a relationship ending based on the news itself. So it's a much more dynamic approach to figuring out how companies relate over time. And you may even be able to pick up on certain types of relationships that are not subject to regulatory filings, right? So both picking up on relationships that may be more permanent or more temporary in nature.
Okay, great. And then we have a question that came in about the data frequency. So what is the frequency of data? And when you talk about a 3 lag, do you mean 3 days, 3 weeks, or 3 months? And follow up, do you deal with intraday data? And if so, how do you deal with those data points or data that has 0 news articles in it?
If you look at, can you say, the underlying raw data, that is obviously in let's call it news frequency. So anytime there is a news story hitting one of the news wires or on some coming across, can you say, the different web sources that we track, you have a record or a number of records, one record per entity mentioned in that news story. We then aggregate that data up into the indicators that we wish to create. You could obviously do it on any frequency you want. It could be a continuous indicator that updates with events, or it could be some fixed update frequency. In this particular case, we created daily scores, and the daily scores we turned into monthly scores. So when I talk about lag values, it's really, can you say, 6 monthly lags in our model. I also did a benchmark model I also did a model that checked for robustness, where I created a weekly model, and in that case, I looked at weekly sentiment aggregates. So I basically try to match the prediction horizon that I have in the model. Were there any other questions embedded in,
okay.
in the overall question?
No, I think, I mean, obviously, I think you've dealt with that one. Just a quick question on the RavenPack dataset. You know, what do you see as the major differences between the RavenPack dataset and other sets of data out there that people could use to construct indicators? News data I'm referring to.
Well, I would say one of the key features is really the event taxonomy, which I think is very strong. We have found, first of all, not only for indicator construction, but also just when you want to generally trade on news, if you only have views on sentiment, the only thing that you can say is something about direction. You can't necessarily say anything about how quickly something decays, right? Some news events, let's say a positive analyst recommendation may be incorporated in a couple of days, where it may take weeks for other types of news events, right? So this is, can you say, the one thing that you get of benefit, that you add this, you can start to add this extra layer of information on top of it to find out the value of the signals over time. The other thing is also that it allows you to filter out certain types of information. And as part of our work creating indicators, we have found that one of the things that you may want to consider or probably should remove from your aggregation is machine-generated news. And there's an increasing amount of that type of news out there these days. And by machine-generated news, I primarily refer to news that are more technical, signal-related. And we have found those type of events having very little value, both as an event trading strategy, but also when you aggregate indicators. Aggregate the data into indicators. The other thing is, which is very useful for the RavenPack data, and when we again refer to the event taxonomy, is that it really provides you a unique way of identifying themes that drive different relationships, or that drives, can you say, the sentiment of a given economy or country, etc., as shown in this picture. And I'm personally very, I find that a very nice feature. By bucketing volume, as I mentioned, it's a very good way of kind of getting rid of some of the noisier, some of the noisiness that you see out there, and especially as you move from the premium newswire services like Dow Jones into broader web content and finally into social media, you will see more and more noise coming through, and here having event a thorough or a deep event taxonomy in place, you know, is very, very useful.
So you just mentioned social media, and I'm sure many people on the call will be interested in how to tackle the problem of sentiment analytics and social media. Could you comment on how RavenPack might go about that?
Yeah, I think social media is definitely very interesting, and as I mentioned, it is a rather noisy source, and the characteristics of what you see out there is also very different, right? So I would say as first steps, we would probably focus on some of what you call the more prominent accounts, verified accounts, for instance, as well. So looking at the corporate's own Twitter accounts and also people that are considered influencers in the market space. And I think that's probably a good way of kind of keeping handle on some of the noise that you see out there. The other thing is that and if you want to, can you say, go for the broader, can you say, look at Twitter as a broader source, looking at individuals tweeting, can you say more of the consumers tweeting? I think what's really interesting there is probably going after consumer sentiment rather than mentions or events around companies. So you would probably need to start tracking something like products and services as well on top of just company names. Very few people, I would think, or we have at least seen when we investigate this, that very few people really tweet about companies. They tweet about what products they like to buy. For instance, they will mention, I really love to buy the new iPhone 6. They won't say the iPhone 6 from Apple. So you need to be able to track these the companies, the products that the companies sell. And I think that's really where Twitter will add a lot of value when you start to be able to grab consumer sentiment. Otherwise, I think you generally want to try to capture trends, so macroeconomic trends, spikes in tweets in certain regions about potential civil unrest or something like that. I think that's where Twitter will really start to show its value. Otherwise, if you just want to pick events or trade based on individual tweets, it's really more of a needle of a haystack approach. And when the media covers these type of stories, they tend to forget the concept of false positives, which can become very expensive trading on if you trade on noisy data, right?
Okay, great. I think we've run out of time, and I don't believe I've got any more questions, but that brings us to the end of our webinar. Let me quickly summarize what we've heard. So RavenPack is in the business of systematically extracting structured data from text to use in financial applications. The data is used in many ways as an event alert or circuit breaker, but most commonly it's used in aggregate as an indicator for alpha generation. And Peter today has shown how you might go about aggregating the data into an indicator for use in what he showed, which was an S&P strategy, but it could be for any asset class or investment horizon, and it's just a question of how you aggregate that data. Of course, if you'd like to have a look at any of the research that Peter's done, please look on our website. That's ravenpack.com. If you'd like to test our data, if you haven't already, please get in touch with us. We have over 14 years of data available for backtesting. If you need to get hold of us, you can get hold of us at info@ravenpack.com. Otherwise, thank you for participating. Thanks to Unicom for arranging the call, and for you for taking the time out to listen. And as I said, please don't hesitate to contact us if you'd like to know more. Thanks a lot, and have a good day. Bye-bye.
Thank you very much indeed, Peter and Hugh. That's an excellent webinar. Just to summarise, if you'd like to know more about our upcoming webinars related to the Behavioural Models Sentiment Analysis Applied to Finance conference, there is a schedule at unicom.co.uk. And again, thank you for joining. Goodbye.